Are you ready to start day trading but you don't have $25,000 to avoid the PDT rule? Well, don't worry, there are ways to get around it and still be able to trade freely. In today's video, I'm going to show you how you can bypass the PDT rule with 4 simple strategies. Let's dive right in. Before we get started, let me quickly explain what the PDT rule is. The pattern day trader rule requires traders to have at least $25,000 in their margin account if they want to day trade more than 3 times within a 5-day period. But don't let that scare you. There are legit ways to avoid that restriction without having to need the full 25K. Let's go through them one by one. Option number 1 is probably the simplest, and that's to use a cash account instead of a margin account. Here's the thing, with a cash account, you're not borrowing money from the broker, so you don't have to worry about the PDT rule. But there's a catch, you can only trade with the money you have in your account. The good news is settlement time has recently improved. Previously, when you made a trade in a cash account, it took 2 business days for the funds to settle before you could use that same cash again. But now, many brokers offer a T+1 settlement, which means you can trade your cash on Monday, and that same cash is available again to trade on Tuesday. So with smart planning, you can get a lot of trading done without ever hitting the PDT rule. I personally use Thinkorswim, which is offered by Schwab, and they do indeed offer the T+1 settlement. Option number 2, open an offshore brokerage account. This can be a great way to get around the PDT rule because offshore brokers are typically not subject to the same US regulations. This means you can day trade without worrying about the $25,000 minimum balance requirement. But just like with anything, there are both pros and cons to consider when using an offshore broker. Let's start with the pros. Number 1, again, no PDT rule. The biggest advantage is you can day trade freely without needing a $25,000 account balance. Number 2, lower capital requirements. Many offshore brokers have low minimum deposit requirements, making them more accessible for new traders. Number 3, access to global markets. Offshore brokers often allow access to a wider range of international markets, so if you want to trade outside of US exchanges, this could be a good option. But there are also cons to consider. Number 1, higher commissions and fees. One major drawback is that many offshore brokers have high commission costs and trading fees. For example, some charge high per share commissions or additional withdrawal fees, which can eat into your profits, especially if you trade frequently. Number 2, lack of regulation. Offshore brokers are not regulated by US financial authorities like the SEC or FINRA, which could expose you to a higher risk. While some offshore brokers are reputable, others may not offer the same level of protection for your funds. Number 3, potential tax complications. Since you're dealing with an international entity, there may be more complex tax reporting requirements. It's important to consult with the tax professional if you're considering this option. Number 4, customer service. Depending on where the broker is located, you might experience slower or less responsive customer service due to time zone differences or language barriers. Option number 3, swing trading. If you're not in a rush to day trade, you can focus on swing trading, which allows you to hold positions overnight and over the weekend. The key here is that swing trading doesn't count towards the PDT rule since you're not day trading more than 3 times within a 5-day period. By focusing on swing trades, you'll build up your account and eventually get close to that $25,000 minimum. Once you hit that threshold, you'll be able to day trade without limitations. This is a slower but steady way to work around the PDT rule. Option number 4, trade with a prop firm. Prop firms are a great way to start trading without needing much capital. You can take part in an evaluation, prove your skills, and if you pass, they'll fund your trades. These firms offer a wide range of trading, including stocks, futures, and forex. Some great prop firms I recommend are MyFundedFutures, Apex Trader Funding, and Tradeday. They have evaluation plans that cost less than $100, especially by applying discount codes, which I'll have in the description below. Once you pass, you'll be trading with their capital, not yours, so you won't have to worry about the $25,000 minimum. Now, while these prop firms offer great opportunities, there are some risks involved, like the pressure to meet profit targets and the rules for drawdowns, so it's important to choose a prop firm that fits your style and risk tolerance. But hey, if you're curious about how to get started with these firms, make sure you check out the videos on my channel. I've done detailed reviews of each of these prop firms. So there you have it, 4 ways to trade without the PDT rule holding you back. Use a cash account, go offshore, swing trade until you hit 25K, or trade with a prop firm. Each option has its pros and cons, so pick the one that fits your trading style and goals. And again, if you're thinking about signing up with any of the prop firms I mentioned, I've got some discount codes and affiliate links down in the description. It would really help support the channel and would be greatly appreciated. If you found this video helpful, please hit the like button and consider subscribing for more content. Best of luck trading in the markets, and I'll see you guys next time. Peace.